Everyone's been saying it's a buyer's market, but is it? Are we in a buyer's market, or is it just summer? I've had kind of a change of opinion in the last month, so stay tuned to the end after we go through all the facts and where we're at to kind of get an idea of where we might be sitting, because I'd love to hear what you have to say and comment down below. Look, I've been selling real estate since 2009. And what I can tell you is this time of year, well, it's always boring. It's a slowdown. It's the summer months. It's the dog days of summer. August, July, and June are the slowest 3 months for buyers in my market. This is pretty common with a lot of national markets. Locally, I have a spring and a fall market. So is this year different, or are we just jumping the gun? Let's dig in. Okay, right now, the headlines are flying. Buyers have the upper hand. And yeah, we're seeing the signs. Let's look at some stats, because I'm a big numbers person. Starting with inventory is way up year over year. This is where the biggest statistic is happening. We're now seeing sellers, AKA inventory, exceeding demand, the number of buyers, by almost 30%. That's a huge mismatch, and that's something we haven't seen post-pandemic. Homes are also sitting longer. We're seeing days on market really exasperate and really increase compared to the last couple of years. And the other thing, price reductions, they're back. So buyers, yeah, they're able to negotiate again. That's something we haven't seen in a long time. All right, let's look at some other numbers because I love stats. Prices, well, they're still up, but not the percentage increase that we saw in the other pandemic years. We're only about 1% year over year increase. That's almost negligible to say there's even been much of an increase in price. But here's the big one. Price cuts just hit a record high, says Zillow, which found that 27% of home sellers slashed their prices in June. And they're not the only ones. Home builders are trimming their prices too. Many home builders, especially those national ones, are reporting earnings down and inventory is not moving like they used to. You can see this because price cuts for new builds, they just hit a 3-year high in July, according to the National Association of Home Builders, with builder confidence now in the negative territory for 15 straight months. And look, that's not the end of bad news. Home sales, well, hey, those contracts are falling through. Redfin reported that 1 in 7 pending home sales, they fell apart. That's the highest level on record. Why is that happening? Well, it turns out buyers are backing out. They found a better deal elsewhere and oops. Maybe you should have had better contingencies and tightened those up a little bit so there weren't so many exit doors. And then the news goes even more so. Look, landlords, people buying the houses for rent, they were surveyed and guess what? Only 50% plan to buy a new income property this year. That's a steep decline because last year when they were interviewed, they said that 70% of them plan to buy another income property. But this year they're citing higher prices, interest rates, and a sluggish revenue growth in rentals as well year over year. So hey, look, all these statistics, they're troubling. They're figures that suggest, yeah, it's a buyer's market. But the biggest figure I'm following, what the difference is this year is, well, that demand is down, way down. This mismatching supply and demand comparison is a lot. Not just because buyers are vanishing, but because affordability is strained. Rates, they're just high. Prices, yeah, they're high too, but the rates are what hurting people the most because the rate is what gets you the sale. The prices, they haven't fluctuated too much. So buyers are becoming picky. And those sellers that were on that rate lock-in effect and still selling their homes, well, we now have more supply than demand in many segments and they're still not selling. That is the key shift. So it feels like a buyer's market. But here's the thing, we see this pattern every summer. August, July, and June, my market, these are consistently the slowest months for buyers, especially here in Iowa City. Look, it's hot. It's way hot. It's vacation season. People are gone. School's about to start. We're a university town. People are prepping. Families, they're hitting pause. That's normal. Here's something that we don't talk about. We'd like to look at markets in annual perspectives, but markets have cycles, and that's important to understand because it's hard to gauge at this point where we stand because it's not just prices that are the main thing holding back, but in this market, it's rates. And that's where the most emphasis is on why things aren't moving. So why do rates matter so much? Consider a $500,000 house at 3%, that'd be $2,100 a month. But a $500,000 house at 7%, that's $3,300 a month. That's a 60% increase. This is huge. This is what's holding people back. It's not the prices of the homes, it's the rates. The interesting thing about rates is they're about the same as they were last year. They're the high 6s. But analysts believe that we need to be about in the mid 5s to see the surge that we saw during the pandemic. So here's what's going on with rates. The news spends a lot of time focusing on the Fed. That's our focus, right? But consider this, really the Fed is the third component that makes up the rate that you see at a bank. Because the number one thing is inflation. That's the biggest thing that's gonna affect mortgage prices. So think tariffs. The second is gonna be the T-bill. Think economic risk, geopolitical and global demand. And then the third is the Fed's monetary policy, the amount that they loan the bank. And here's an example. In late 2023, the Fed kept the rates flat. But inflation cooled and rates, well, they came down, even when the Fed did not change rates. So you see, the mortgage rates will change even if the Fed doesn't make a change, based more on inflation expectations as well as what the T-bill is doing. So here's how it works. The Fed loans money to banks, who then those banks, based on what they get charged for their loans, they charge consumers. Example, people buying houses. And so those are the mortgage rates that you see at the bank. These are, of course, higher than the Fed's rates, but they don't react just to the Fed, they react to what the Fed may or may not do. Plus, monitoring inflation, and of course, the T-bill, which are short-term bonds. They're the alternative for investors that want better returns on a short-term investment versus a long-term investment like mortgages. It's the classic return versus risk. Which is better for investors? And short-term will always win if there's a better rate. So this is what we should watch for when you're looking for rate indications. For example, the last few years, there were some rate indications that drops were gonna occur, and whether the Fed made a change or not, mortgage rates went down because there was an expectation for a drop. And that is what drove it. Here's what I'd watch for. I'd watch for mid-August. The last 2 weeks of August are great possibilities for when we could see rates come down a little bit. And then, depending on what the Fed does in September, this could indicate what they might do again later in the fall, based on their meeting and their minutes, and there could be another dip, but that's less certain, in my opinion. I think I would watch for August market. That's a lot of information. Is it a buyer's market? Here's what I'm telling clients. We're in a buyer-favored market right now. But it's not a crash, and it's not 2010. It's what happens when the market breathes. It's a correction, not a collapse. Buyers finally have the opportunity to be picky, and that's healthy. But how long will this moment last? Not forever. Once rates drop, or even stabilize, demand could surge, and the balance could shift right back. So here's my translation. Yes, we are in a buyer's market, but not for too long. And it's not summer that's slowing things down, it's fatigue, fear, and a wait and see mentality. It's not just the seasonality. The smartest buyers, they're the ones making the moves before everyone else jumps back in. And that could happen when we see some rates go. And the sharpest sellers, well, they're adjusting prices, staging and marketing now to stay ahead of this curve. So if you're waiting, I wouldn't wait too long. So what do you think? Think it's buyer's market? Drop your thoughts in the comments down below. Let me know if you've seen a shift in the market. And if you're in the Iowa City area and you want some strategy as a buyer or seller, let's connect. Thanks for watching. Price cuts for new builds, they hit a 3-year high just in July. Why can't I? What the fuck is wrong with me, man? July? What the fuck?